On this video, I want us to continue the presentation, or introduction at least, to the GAAP conceptual framework. There's a lot here, and it can be pretty confusing. A lot of new terms and concepts, and it's understandable if you're confused by that. In some sense, what in the past, I've found it useful to explain this material in this way. Let's imagine that you are setting up a closet. And we're talking right here about where you're going to put the shoes, where you're going to hang jackets, where you're going to put shirts and pants and socks and those sorts of things. But imagine that you are coming from a culture where you don't really know what pants and shoes and socks are. So we're going to describe the closet, describe where things go, and in general describe what a jacket looks like and what purpose it serves and what socks are and that sort of thing. But realizing that until you actually see them in use, that it's not going to make as much sense as we might like right now. So as we talk about these various qualitative characteristics, the various levels actually of the framework. First level, basic objective of financial reporting, where we establish the goal of financial reporting. And then the second level, fundamental concepts, where we're going to be talking about, or have been talking about, qualitative characteristics of accounting information. And we've talked about fundamental qualitative characteristics, and now we're going to be talking about enhancing qualities of that information. Just I want to encourage you to hang in there and not be too discouraged by the new terms and the confusion of all this. It will make sense, or at least more sense later on, once we get into and see the applications of some of these things. But having said that, let's talk about these enhancing qualities. Now, keep in mind what we've talked about leading up to this. The qualitative characteristics of accounting information concerns those attributes that make the information useful in decision making. And so these qualities can be broken down or understood as, first of all, certain fundamental qualitative characteristics, and that's what we have just looked at. Just to look back at that, with these qualitative characteristics are relevance, which have some various components, and also faithful representation, and there's some components of faithful representation. Don't want to rehash that, but keep in mind these are fundamental qualities of or characteristics of accounting information. And now we're talking about enhancing qualities. If you were to describe a house to someone, there are some definition, or let's say some elements of a house that are absolutely fundamental to have a house. You've got to have walls. Now, you may not necessarily have four. And of course, in many houses these days, modern houses, you have many of those. But fundamentally, we probably would assume you've got to have at least four walls. You've got to have a roof, and you've got to have a door, some way to get in and out, an opening at least. Someone might say, well, you've got to have windows. You probably don't have to have windows to make a house. You might believe you've got to have some kind of flooring, carpet, maybe furniture and that sort of thing. But again, people might argue that, those things like windows might enhance the usefulness of a house, make it nicer to live in, but may not be fundamental to the definition of a house. So think of it that way. We've got some fundamental qualitative characteristics, that characteristics or attributes that are absolutely essential to information that is useful in decision making. And we have others that are enhancing qualities, that is, that improve the usefulness of information. So having said that, let's look at these enhancing qualities. First of all, comparability. Comparability concerns measuring and reporting information in a similar manner to help users discern similarities and differences among entities and conditions. And these similarities, or this comparability that we want, is comparability between companies, and also comparability from period to period for a particular company. If entities aren't comparable, if we allow too much leeway in how they record revenues or expenses, or what types of values they might use to value their assets, then we would find it much more difficult to determine how one company is faring relative to another. In other words, how Nike stacks up relative to Under Armour or to Adidas. Consistency enhances comparability by measuring and reporting events in the same way from one period to another. So it's consistency means that you are applying the same measures of, let's say, accounting for revenues and expenses and valuing assets and liabilities and equity and so on. Does this mean that a firm can't change treatment of some event? And the answer to that is no. There are situations where a company can change. As a matter of fact, we'll see companies may change applications of accounting principles. You will recall that companies in depreciating assets can choose between straight line depreciation, which means they depreciate the same amount each period for a given asset over the life of that asset, or they might use one of a family or a group of accelerated methods like double declining balance or some of the year's digits. Now, a company could change from straight line to, say, a double declining balance, which would mean that the results would not be the same with that change as they would have been under the old method. Very often what we will have to do is, when the company does change an accounting method like that, it will have to go back and restate prior year statements in the annual report so that users of those financial statements can make the comparisons, the legitimate comparisons that are possible only if the data is consistent, or the numbers are consistent from one period to another. Verifiability is another enhancing quality. That occurs when independent measurers arrive at similar results. Objectivity provides this. You know, as accountants, we prize objectivity. That means that different parties looking at a particular transaction will come to the same conclusion, let's say, about its value. Let me give you an example. Let's say that you've got a company has a piece of property on the northeast side of Atlanta, and they bought this property 20, 30 years ago for $100,000, and now that property is worth $5 million. Well, to say it's worth $5 million, you'd have to have an appraisal, or maybe get a realtor or someone to come in and say it's worth $5 million, maybe even a prospective buyer. We're not going to change the value of that asset in the financial statements, specifically on the balance sheet, just based on someone's opinion or assessment of what that asset is worth. Now, a group of accountants, a group of people, even business people, may come together and might have all kinds of opinions about what that property is worth, what its market value is, what it could be sold for. But there would not be any question about what the company paid for it. That's why historical cost we consider to be, for assets, to be probably the most objective measure of value that there is. We could all look at the deed of sale when the item was purchased. We could all look at the canceled check, at the contract, and that sort of thing. So everybody might have different opinions about what the property is currently worth, but they would be absolutely united on what the cost was when the asset was purchased. And it's what we'll see in financial statements, in the balance sheet in particular, and particularly on the asset side, that historical cost is the primary attribute of value that we find represented in the balance sheet. We can all agree on it. It's objective. And so when relevancy, that is usefulness in decision making, and objectivity, verifiability in this case, when those go head to head, usually verifiability wins. That is, we probably would say the company would argue that what the asset is worth, what that land is worth, is a lot more useful in determining the company's value or its future prospects than what it paid for this land 20 years ago. But when it comes to actually presenting the financial position of a company, we will use historical cost because verifiability, objectivity wins out in this case. Timeliness means that information arrives in time to be useful. It doesn't matter how accurate it is, how good the information is, if in fact it comes too late to be useful in making decisions. The publication of annual financial statements is an application of this notion of timeliness. That is, companies don't issue financial statements every 2 or 3 or 5 years. We believe that at least annually, users of financial statements need to have that confirmed, verified statement of the company's financial position and performance and cash flows to make decisions that they face. Understandability. The quality of the information is appropriate to the users. But now the users are assumed to have a reasonable understanding of accounting. As you know, even though you think you don't know very much about accounting, that you'll know a lot more at the end of this course, of course. But the financial statements are not supposed to be so simple that anybody walking in off the street can understand them. It requires training. It requires a reasonable understanding of accounting. And sometimes if you ever listen to C-SPAN, I don't do that much, but one time I was listening as a Senate subcommittee it was in the wake of the Enron scandal, and someone from a CPA firm was explaining the notion of the accrual basis to some senators or representatives, in other words, to some Congress people. And this senator thought he had really discovered a huge element of fraud because he realized that this company was recording the revenues before they actually received the cash. Well, that's the essence of the accrual basis. We record revenues when they're earned and not necessarily when the cash comes in. We record expenses when they are incurred, again, not necessarily the same period when the cash is paid. And so in this case, I'm not sure the senator was as embarrassed as he should have been to be on that committee and to have so little, to be on that committee and yet to have so little understanding of basic accounting. But again, the notion here is that it is assumed that in using financial statements that they should be understandable to a person who is reasonably informed about accounting. Now, there's an overriding constraint on all of these. That is, the applications of these and the pursuit of these, the qualitative characteristics, and that's cost effectiveness. What this means is the cost of providing the information should not exceed the benefits it provides. There is room for judgment here, but keep in mind that this is an overall constraint. There might be some very detailed or intricate methods of valuing assets that might be superior to ones that are commonly used, but the cost of those, for instance, having an appraisal or a market study of every single piece of property the company owns every year to determine the values on the financial statements, but that wouldn't be cost effective, and so those sorts of means of determining value are not used for that reason and probably for certain others as well. Keep in mind this overriding constraint of cost effectiveness. Now we move to the basic elements of the financial statement. So we're talking here about the basic form and content of the financial statements. That's something in class we will be spending some time on pretty quickly here. They are the building blocks from which the financial statements are constructed. Now, there's a list of definitions on page 25. I say here my list is slightly different because what I emphasize here is assets, liabilities, equity. You'll probably note those are the main categories on the balance sheet, revenues and expenses, and gains and losses, and those, of course, appear on the income statement. I want you to memorize a number of definitions this semester. You'll remember there's going to be a glossary quiz at the end, 25 to 30 terms. Well, go ahead and start with these terms, these 7 terms: asset, liability, equity, revenue, expense, gains, and losses. You've also got among these elements of financial statements investments by the owners, distributions to the owners, and other comprehensive income. We'll address those later on, but let's start with these very important and basic ones here. Okay, those are the elements of financial statements we'll spend a lot more time in. Let's look now at the third level of the concepts of the GAAP framework here, the basic assumptions. And these concern recognition and measurement concepts. The basic assumptions underlying the financial statements and GAAP are these: the economic entity assumption. This says that economic events can be identified with a particular economic entity. You may recall from principles of accounting that when